Sold at 560.
785 the first, 785 the second, be sure, 785 third, final time, sold. The third and final time at £910,000, sold. So welcome to the latest edition of the Allsop Prop Chat. My name's George Walker. I'm here with my colleague Richard Adamson, both auctioneers, and you know us both very well. Today we're going to cover permitted development 10 years on and how does it look now. Not the normal domain of auctioneers, but so I've got two experts with me actually, Andrew Boyd and William Shoebotham from our RTLM markets. Andrew Boyd, head of the RTLM side of Allsops. Boydie, what's your background?
Thanks, George. My background is very much planning originally. I spent most of the 2000s as a town planner, local authority, and then private consultancy side before moving into agency in about 2010. And my responsibility at Allsop is to head up the residential, transactional and living markets team, which focus on development, residential investment, student and build to rent.
Build to rent included, isn't it? And from London and Leeds.
London and Leeds, exactly.
Yeah,
partly there, probably a third of the team in Leeds and 2/3 in London.
Okay, good. William Shoebotham, been with Allsops for a long time.
14 years, yeah, man and boy. You were actually my first boss, George.
I know, and I gave you a job.
You did.
And I was probably, yes. Anyway, moving on. What's your gig at the Allsop team?
Yeah, so I actually started as a graduate 14 years ago, rotated around the company, during which time I spent 6 months at Granger on secondment. And then since then, I've been in the residential investment team. I'm now a partner, but I've been in the team for 12 years.
Okay. That Granger experience, you're one of the first, weren't you?
I was. So I went over probably about 10 years ago, and at that point in time, Granger had just set up what was called RAMP. It was a residential asset management platform,
Yep.
and they were dealing with a load of the Lloyd's kit. And so I was the first to go over on a 6-month secondment. And then following me, I think we probably sent about 5 or 6
Alex
graduates
Greaves
over.
is-
Yeah, Alex
is part of
Greaves is
that
now
group.
M&G. Yeah.
Now at M&G.
So no, it was absolutely brilliant, to be honest. And I still have weekly calls for them, to be honest. So yeah, it was really profitable for For
Good.
me
So we've
and
got
my
two
team.
experts in that market, and the commercial auctioneer world, which is mine, is really the only link here is that we spent a lot of time about 10 years ago involved in permitted development blocks, and the biggest lot Allsops ever sold was a £13.5 million piece, the biggest lot we sold in auction in East Putney, which is now residential. And Richard, really, you spent a lot of time in this sort of early noughties in this sector.
Yeah, very much so. When PD first reared its head, it hit the ground running pretty quickly, and we certainly had in the auction. I mean, it was a lot of stock we sold in a 4 or 5 year period of time, predominantly from, dare I say, where commercial investors didn't quite know what they had, and traditionally an office building that was vacant or soon to becoming vacant was seen as a very much depreciating asset, which it used to be. And there were some resi guys out there which understood the new PD laws and what they could and couldn't do and how quickly they could turn things around, and actually capitalised on that by buying things at low prices compared to resi values, but probably what commercial investors would have paid for something traditionally for vacant or fag end leases.
And those regulations on PD are pretty weak, weren't they?
Well, that's where I want to start really, is to ask these guys here really to remind us all. It's, as you said earlier on, George, it's almost 10 years since PD came about in 2013, and there's been a lot of changes, and we've kind of come back to where we were almost. So, Andrew, how would you summarise that 10-year period and how things started and what it created to where we are now?
I think when you look at it, if you look at the housing numbers that we had in 2012, 2013 on the back of the financial crisis, from a UK perspective, I think it was something like 125,000 homes built, and with the target now being circa 300,000 that people have been aiming at, there was obviously a requirement to do something to try and stimulate supply. That came in the form of PD. It came with very little regulation, as you say, and the legacy of it will always be considered questionable. So from those 2013 beginnings, when you moved forward to 2015, 2016, it was a question as to whether it was going to continue and in what guise. And it has evolved a bit over the years. And what we've seen more recently is a return of it in its what's considered to be full glory, if you want to put it that way, because back in 2020, 2021, when it was changed under the General Permitted Development Order as Class MA, at that stage there were restrictions around vacancy of buildings, the size of offices that could be PD'd as well, with the upper limit being 1,500 square metres, whereas I think what we saw last year with where the Conservative government was and the desire to try and create some stimulus for the market, the consultation that came out in July was quite interesting. There was a lot of reference to agricultural buildings and PD, and the consultation finished at the end of September. And there was that little reference to either increasing the upper limit or removing it again for Class E, which typically encapsulated the old office buildings in Class B1A. And so what we expected to see was that come in pre-Christmas, in honesty, with the assumption that it's going to be a pretty hard-fought general election this coming autumn. You would have thought they would have allowed sufficient time for the impacts of that policy to come through. But it was only on the 13th of February that it was decided that that would then come in, and then it subsequently came in the 5th of March with a little bit more regulation than previously, but at the same time, with the intention now of being able to deliver offices to residential on a large scale.
So a couple of points there. You mentioned that obviously back 10 years ago, how did you phrase it, that there was the legacies of some of those buildings might not be what we wanted them to be. Can you sort of delve into that a little bit more as to what that was and what the outcomes were because of regulation and because of how they were being delivered?
Yeah, I mean, in terms of the process of getting prior approval for a change of use from what was Class B1A at the time into residential, it was a narrow set of factors that needed to be considered. It was contamination, it was flooding, it was traffic factors as well. And when you consider that most office buildings probably wouldn't experience or wouldn't have a likelihood of contamination, and in a lot of instances the buildings that were changed were office buildings that had car parking anyway, it typically came back to whether the flood risk zone made it acceptable to change the use. What wasn't factored into the legislation at that time was anything relating to the amenity of residents, daylight, size of units. And I think where you look at examples of PD that hasn't gone well, it's typically the poor quality amenity that residents experience, as well as the fact that a lot of those schemes are delivered mainly as studios rather than meeting national space standards. So it was very clear that there were two factors that needed to be addressed, and the amendments to PD in 2020 and 2021 addressed those 2 points.
So in a nutshell, though, there were a lot of properties in the market then from 2013 for the sort of 2-3 year period that have been delivered, very small units, poor build quality, aimed at lower end of the housing market. So it was as many units as you could possibly fit into a building, come what may. It was really...
It was, and it was aimed at the lower end of the housing market, but it was also a recognition of the fact that house prices were getting difficult for people to get on the ladder. So, the reality was that the smaller the unit sizes, the smaller the capital values. But at the same time, it created a scenario for developers where they were able to include more units and deliver higher pound per square foot values as well.
Yeah. And sort of flip-flopping across to what you saw then, Will, or are seeing, is what the investment market was like for those products that were delivered on the early years of PD, and they're in the market now and presently.
I mean, there has been a stark difference between what we were seeing in 2015, which is when we first start seeing the PD being delivered, versus what we're seeing in 23, 24. In 2015, we sell investments all across the country, and we were seeing all these sort of regional PD sort of investments come to life, but the issue that we had was that whilst they act as sort of good cash cows, and they do actually service a market for both rentals and purchasers alike, the issue that we would commonly have when we were taking people around these investments was there was poor workmanship. I think people were spending sort of around £100 a foot on these conversions. And ultimately, as you were going from flat to flat, there were compromised units in there as well. So it felt like people just cramming people in on the renting side and just really trying to maximise income as much as possible. And because of that, the investment market would only pay certain yields, which were typically double-digit gross yields for these kinds of investments. But
even in low interest rate environments.
Yeah, no, they would, because ultimately the perception was there was no breakup option, i.e. you weren't going to sell these individual units to the owner-occupier market.
And assumed by the quality of the build, the quality of, dare I say, tenants, and therefore voids and refurbs and capex is therefore going to be assumed to be much higher, and the gap between gross and net widens.
Correct, and furthermore mortgageability issues. Small units, sub 300 square feet at the time, you're not going to get mortgages on these if you're going to break them up. So the yield is always being pushed out. Yeah. But fast forward to 2023, which is when we saw after the 2020 announcement where minimum space standards came into play,
which are
now 37 square metres. So the units have to be in excess of that size. And that tied in with last year when suddenly we saw just such an influx of really good quality PD. And we sold over £100 million worth across 5 sales in the M25 last year alone. And what we really saw actually was that stigma attached to PD was starting to fall away, and the profile of buyers was going away from the sort of high net worth and local buyers in the regions to actually institutional money looking at the sector, which was therefore driving yield as well.
And how many of those, in those 5 out of 100 million, how many were institutional buyers?
4.
Were they?
Yeah, 4. And what is also interesting, of those 5 sales, it was 5 different buyers. So we're not looking for one party to prop up this market. And probably 3 of those buyers I would have never associated with PD previously. But the point being, I think now is that because funds are now looking more so than ever at sort of ESG qualities around buildings, they're now looking at the repurposing of these buildings. So it's sort of gone full circle that they're actually seeing these buildings being reused, and it's actually a real positive. But what they will not allow for is a lack of quality.
Yeah, right. And just going back, so back to you, Andrew, is that in the middle of that 10-year period or journey of PD, there was a change, wasn't there, whereby you were limited by size and there were certain parameters put in place. What was that designed to do, and what did it actually achieve?
It fundamentally was designed to create units that were fit for purpose. And it's hard to tell the legacy of that. I think what you had was a real flood from 2013 on, when there was no minimum space standards. And then when you look at the period when those space standards came in and some of the other factors to create better units, that coincided with a time where the larger scale PD wasn't coming forward because of the restrictions around the size of schemes.
That specifically, though, when it was the 1,500 square metres, what impact did that have? I'm assuming a lot of people that were specialising in that market backed straight off because it completely narrowed their market down. Is that really what came out to play, or did you get better quality, smaller buildings being converted?
I think you did get better quality, smaller buildings converted, but it didn't really make a big impact either in terms of housing numbers or on the market. You know, the reality of a lot of the PD specialists, they want to be delivering at 100 units plus. And so when they went through a period where they were delivering schemes that scale to go back and deliver much smaller schemes, they weren't really the buyers for those sorts of assets. It was much more localised type buyers, local builders, people who had existing commercial buildings, you know, who were across a number of different sectors and had a construction capability themselves and were delivering as well. So, you know, undoubtedly it has created better units, but it's on a significantly smaller scale in terms of its impact on the market than what we saw from 2013.
And the point being, I think also what we've seen is from back in 2013, there are now these specialist PD developers who really know what the market is looking for in terms of that institutional end product. So what they, you know, it's uncompromised units, it's making sure they're aligned with minimum space standards, you know, not in the middle of an industrial park, for example, or an office park. So they know exactly the kind of buildings that they're looking for because they know what that exit is and where those exit yields can be if it's the right product.
Isn't that just a house builder?
Well, you could call them that, but there are certain, I mean, we deal day in, day out with 3 or 4 specialist PD buyers who won't actually do new build, they'll only do conversions.
And conversely, you'll get a lot of house builders, traditional house builders, ground up, who won't touch that stuff either.
And actually what a lot tend to do is they will pair up together often. If they're buying a site, for example, and there's this existing office building on it, but there's loads of car parking where they love to do a new build scheme, they will bring in the specialist in each area to develop the component parts of the site.
Yeah, I think it's coincided at a time where the house building market has changed quite a lot. Even if you look at London and a lot of the big developers, you know, Barratt and Barclay are synonymous with higher density development in London. And, you know, they're probably one of the few PLCs who are still delivering flatted schemes or city centre schemes. An awful lot of the other house builders, particularly with the strength now of the single family BTR market, they are looking at housing. So PD developers I wouldn't necessarily consider to be house builders because they are very specialist and much more focused on city centre markets. And back to the point about just making sure that PD works in the right locations. We have seen scenarios in the past where office parks, which don't feel like residential locations, have been converted into residential, whereas I think the next wave of PD we'll see on the back of the current legislation, I think with market factors at play as well, people can't really get these things wrong. They need to be delivering the right products in the right locations.
Because to convert an office location to a proper place to live is a lot of capital, a lot of scale, a lot of capital. You can't just put a 30,000 foot building. I assume you need to use the whole site and everything around it and get the infrastructure right and everything else.
I think so. And I think a lot comes down to, if you're buying a single office building in a wider office park or a location that is historically commercial with industrial factored into that as well. We have seen those. But if you look at the requirements that you need to address in putting in your prior approval application now, in addition to the contamination and the car parking, the flooding we spoke about that you needed to do historically, there are other factors now relating to, the daylight as we spoke about, but also the impact of noise on surrounding uses. So it is pushing naturally for office buildings that are in town centre type locations and in sustainable locations to be the ones that are brought forward rather than the ones that are in wider commercial areas.
Okay, so it's grown up a lot, hasn't it? And it's developed a lot over that period of time. But it would still be fair to say that there will be operators out there that are producing some of the higher end, better spec, better quality, institutional appealing developments. But there will also be some entry level that can deal with some of the lower end of the housing market that needs that more than it had before. So there's going to be a wider spectrum of delivery, I suppose.
Yeah, the answer is there is a market for both. But if you want to hit those sort of institutional yields, and the yields we were achieving last year, Worley HQ, for example, which was a 300-unit scheme in Brentwood, we were selling that for 5.5% gross yield, which nets back to probably
5.5%
around
gross.
Yeah, so that nets back to 4, and we're talking brand new build-to-rent yields there.
Which, interestingly, just reflecting for a second, we had Anthony Hart talking about rental growth and student, and that implies a lot of rental growth in your sector, a hell of a lot. I mean, the 4% net, you've got to want some growth out of that.
But the only thing about that is that was probably going back about 18 months, wasn't it?
Well,
and prior to what we've seen in the interest rate market, which definitely has affected residential.
Yeah, so I mean, interestingly, across the 5 sales that we had, which were last year.
You're very proud of them, aren't you?
Well, I am, actually.
Quite, you should be as well.
But no, it's interesting because the first was in January, the last in December, and we saw all the base rate movements across the year. So that 5.5% was turning to sort of 7.5%-ish% gross by the end of the year, which was simply just tracking the base rate movement as well. So it'd probably be wrong to suggest that, we could exit all at that kind of level, but it shows where it was and where it can potentially get back to.
Yeah.
So going to Article 4 then, how's that changed? Have more local authorities taken up that now, given that the regulations have changed and the restrictions on space on 1,500 square metres has changed? Are there going to be ones that want to invoke that? And if so, is that a slow process? And is there an opportunity right now where local authorities are behind the curve and there's opportunities to buy buildings that may, in the next year or so, be out of the remit of permitted development?
Yeah, I mean, the Article 4, I think it was about 2015 that really popped onto the radar to try and restrict councils from losing their office stock. It really does vary from borough to borough. If you look at London, there's a lot of local authorities that historically put large swathes of the borough with Article 4 directions on them. The city has a blanket one. Most of the central activity zone, which covers Westminster and edging across basically into Zone 1, a lot of that area was covered as well. What's being encouraged now with the NPPF, the overarching planning document in the UK, is to ensure that they aren't just put on there to be unnecessarily prohibitive. There needs to be a strong justification and a rationale as to why certain areas are being protected. What happened probably going back to 2020, 2021, where you saw the change around the size of buildings that were capable of being PD'd, a lot of local authorities were pursuing strategies around Article 4 directions to protect some of their bigger office locations, bigger floor plate buildings. With the restriction to 1,500 square metres, a lot of that wasn't necessarily seen through. So I suspect the guidance that changed on the 5th of March is encouraging an awful lot of local authorities to try and hastily react to that.
And how hastily can they react to that?
They can't hastily react to it because it's the planning system, but ultimately, they need to go through statutory consultation processes. And the reality is it will take probably up to a year to put some of those Article 4 directions in place. So undoubtedly, there is a window there, albeit, we, in some respects, when this was mooted last autumn, were wondering whether all those Article 4 directions that were put in place previously would still stand. Ultimately, they do. And now it's a question for the local authorities to create additional ones in response to trying to protect some of the offices.
Is there much visibility on who might now decide to want to change tack and have Article 4s in their areas that currently don't? In other words, are there areas that people probably want to try and focus on?
I think it's very difficult to identify specific areas. Typically you're finding people buying buildings, engaging with local authorities in advance, doing their pre-apps and whatever else, and finding out at that point that there's a very finite window for them to purchase the building and get their prior approval, because there's a clear direction of travel in some of the local authorities in certain areas. So it's not as transparent as that. Obviously, as a process with consultation and everything needed to be doing publicly, each local authority will state where they are doing that, but at the same time, as a direction of travel and certain locations to focus on, it's very bespoke, dependent upon the borough.
And it's fair to say that with the shift in working habits since COVID, particularly in major cities, but London as an example, there's going to be some pretty good opportunities there, some really good quality buildings in really exciting locations. Would that be fair to say?
Yeah, absolutely. I think everybody was going back a year or two, when working practice had changed, everybody was looking at secondary office buildings and thinking, is there a future for them? Particularly those that were either, vacant or tenancies were running down. So there is undoubtedly an opportunity now. And I think right across the living sectors, whether it's PD, whether we're seeing repurposing for student, co-living, it's not necessarily confined just to C3. Probably worth stating there that permitted development regulations do focus on C3 and not necessarily these other use classes, but that repurposing agenda for good quality buildings in good locations is there right across all living sector uses as well.
Crystal ball gazing, where are the opportunities going to be and where are the new hotspots going to be?
Well, I think in terms of what we've always found is that in terms of we're looking for the end products, that you need to try and be in areas where you've already got sort of a residential community, i.e. not on the cusp of office parks. And you need, if you haven't got amenities around you, we're now sort of entering a stage where you need on-site amenities as well. So I think, the typical sort of London zones 1 to 6 areas are always popular, and the majority of the kit that we have seen of late is that sort of M25 fringe, which probably ties in with where the vacant offices have been. Anything within zones 1 to 4 where there are opportunities, I mean, we all know where rents are in London and the difficulty that many sort of first-time movers to London have in terms of renting space. There's always going to be a demand for those sort of zones 1 to 4 locations.
If you look at the stats, Rich, in relation to the number of starts, you're 47% down last year on a 10-year average in London. 47% down. And that's the impact of all the build cost rises we've seen, the impacts of, a slow planning system that's creaking, the lack of resource in local authorities.
Well, that's an easy win for a new government. At the end, by Christmas, we'll have a Labour Party. I mean, that's technically an easy win, but whether the system will allow them to do anything quickly.
That's the real challenge. And the question, I guess, of whether, assuming we're probably going to end up with a Labour government by the end of the year, the question of whether they want to fundamentally alter PD, because the benefit of, PD in the form that we're going to see again is even though there's additional regulation that is required around submissions and fire regulations are an awful lot more strict than they were previously, that will lengthen the time period inevitably with building regulations and delivery on site. But when you're talking about a 56-day period for obtaining prior approval, even with additional red tape around building regulations, it's still infinitely quicker than what the planning system is. I think
one of the joys of PD, it doesn't require any government finance. It creates jobs, it provides beds, but it doesn't increase your borrowing requirement. And today's the day the borrowing requirement has gone up. So that should appeal. The whole mechanics of the PD as it stands should appeal to a socialist government. But whether the system will allow it.
Absolutely. And I know, was it October last year in the Labour Party conference, they were talking about the 300,000 homes a year which had been downgraded to advisory by the Tory government as mandatory again. And that's something that's going to have to be delivered in various guises, talking about development corporations, still protecting the green belt and significant nature sites.
The grey belt, I think you'll find.
Well, there's the grey belt in addition to the green belt, which is obviously focused on areas of car parking, whatever that might be in the green belt that doesn't have any merit to it. So It's all these different initiatives to lose PD, even though PD probably only accounted for, judging by some of the stats when it was in its full guise, was only delivering 10 to 15,000 units a year. At the same time, it is something that will deliver a contribution. But knowing the Labour government agenda with affordable housing, you might see some amendments to the PD legislation to ensure that either there's payments in lieu or units on site are captured as part of that.
Well, with the amount of vacant office space, I think within London alone, I think within the M25, there's the ability for 28,000 new homes now. So a lot of that vacant office space won't be appropriate for PD, but a lot of it will. So you're right, there are some easy wins there. And you'd think with the new legislation that those easy wins will be delivered through these, specialist PD developers.
And quite frankly, anyone of our clients that owns offices would be delighted. Either get rid of PD or reduce the supply of offices and bump the rents up. That should be the other side of the equation.
Opportunities moving east, city fringe, all that kind of way with the office uptake. Is that a big opportunity across there?
We've seen it in the city. It's been fairly heavily documented what's happened in New York and places, and the City of London has adopted a more lenient stance around the change of use of buildings.
Is Article 4 a problem over in the city?
Yeah, well, there's a blanket Article 4 in terms of permitted development, but the change of use obtained through planning permission is still feasible there. And, they're openly talking to developers around the prospect of that. We've sold buildings that were previous offices that had change of use planning in place for service departments. With the growth of co-living, there's quite a lot of developers focused on central London Zone 1 student as well. And so you can see the leniency from the city from a change of use perspective, but whether that removes an Article 4 and allows PD, you just can't see it happening, being such an economic hub. The reality of the surrounding areas, once you're getting into your Old Gates, which falls in Tower Hamlets, your Shoreditches and places which stretch into Hackney, there are potential opportunities around there, but again, it is very much linked to Article 4 directions and what those individual councils want to do.
So the positives there are that the market's changed fundamentally in the investment sector, and will continue to change as the quality of the products that are delivered change and get better. But it's a much wider spectrum to the market. And there's going to be a lot more opportunity because of how the world's changed and the planning has changed in PD for opportunities going forward for developers, specialist developers and newbies to the market to develop well-located, good quality office space.
Absolutely. I think you're going to see a bit of a cycle now because with the restriction on the upper limits being lifted, you'll end up seeing an awful lot of buildings sold or bought without the PD in place. Some of those will be bought by speculators who then go and get the prior approval and then trade those buildings ultimately to developers. And from what Will saw in relation to the residential investment market, again, it'll be some of those larger buildings coming through to help housing supply in 18 months, 2 years' time. And the reality of what we've seen with the changes in the PD legislation and creating better units and the fact it's now institutionally acceptable and includes amenity spaces and gyms and other facilities, PD has got progressively better. And I think we will see that cycle happening over the next 18 months from that speculator phase right through to delivery.
Yeah, look, I mean, from the investment side, I completely agree. I mean, the stigma that was attached to PD is slowly dissolved away, really, with these institutions buying these investment products now. And it's just widened our market, which has therefore pushed yields. So from our side, I think as long as the quality is there in strong locations, then it's definitely an area of growth across London.
So in short, if you've got a nice, well-let PD conversion investment
Give
to
us
sell,
a call. Yeah.
get in contact with us and speak to Will. And if you've got office buildings that may be repurposed or got some potential there, get in touch with us and speak to Andrew Boyd. There's an opportunity out there, and dare I say we're well placed to advise no matter what you've got.
I think it's definitely a point in time thing. Obviously we've said PD is 10, 11 years into existence now, but at the same time, with potential changes in government, with the fact that when you get the PD, you have a 3-year period to deliver it, not just start on site, particularly with challenges around tenancies and everything else and getting vacancy of a building in order to be able to do that, time is of the essence, even though we're only 6 weeks into it coming back again.
So Richard, Andrew and Will, thank you so much. I wasn't very central to that podcast. It was a nice break for everybody. Feedback, as always, is welcome. richard.adamson@allsop.co.uk or george.walker@allsop.co.uk. We look forward to your comments, always useful, and will guide us going forward. Thank you very much.